Good afternoon, everyone. It's just after 12 o'clock here in California on the 7th of July. I'm putting together this quick little video to help out a friend. You know who you are because I will direct this video to you privately when the time comes. But you are asking for something that will give you consistency related to trending and looking for triggers. Now, understand that the markets are full of opportunity. So when you're looking for consistency, I'm going to show you something that I think is pretty consistent, pretty valuable, and as a simple strategy, it's very easy to deploy. So first off, let me hide these. First off, we are going to use just moving averages, okay? And so that means we're going to be using this 14 period moving average and a 24 period simple moving average. And when, of course, the 14 is above the 24, we're looking for bullish trends. When it's the opposite, we're looking for bearish trends. When you get a large breakout range, and I'll show you this in a moment, you need to be cautious of that. I'll show you as we go forward. This is 2019. I wanted to show this to you in a moderate upward trend so you can see how it plays out. Secondarily, use a 3.5 and a 7% envelope, 3-bar as a measured targeting system. So here we have our envelopes. There's our 3.5% envelope of a 3-bar moving average. So that's basically, as you can see here, we come in here to the editor, length of 3%, 4, if I can get 3.5. Yep, okay. And there we are. There's our 3.5% average envelope. And what we would be doing here, folks, is this would be essentially our first little target. We would like to pull off a third or a half or whatever we have in here to try to predict what is, protect our profits. So typically you want to try to, when you want consistency, if you want to get to 70, 80, 90% trade accuracy, the trick is to pull 50, 60% away from the trade as quickly and as profitably as possible with consistency, and then let maybe a runner go. Now, obviously that runner at 20 or 25 or 30% should have a stop system in place that protects against any downside risk. And then lastly, as we're using the anchor bar system as a trigger, I'll turn on the anchor bars and turn on this last envelope, which is our outer envelope. And what we're going to do here, folks, is we're going to start on this bar. So we get a pullback. We get downward anchor bars right here. Okay, we're in an upward trend with the moving averages. We ignore this. I mean, yeah, we could take it. The way the trade would work is we get a confirmed anchor bar here. Okay, we would come down here and set a target right here in this area, make it red. And then that is our 3% target at the trigger bar. And here is our 7% target at the anchor bar. So what we would be looking for here is to basically pull 60%, 50, 60% off at this level, and then possibly another 20, 30% off at this level. As soon as we hit this level, we want to try to protect against any downside risk. So what we would try to do is try to move our stop down efficiently. But remember, we're not taking these short trades because we're in an uptrend. And that's generally the theory. So as you move past this 3.5% level, you want to try to protect your trade efficiently, maybe trailing it downward. So here's a new bullish anchor bar in bullish trending. This is our new bullish signal. So what we're going to do is we're going to move these back over to here. Here's our anchor bar. There's our 3.5%. And I'll make it dark green. And here is our 7%. Make this dark green. And so what we're looking for here, folks, and I'm going to try to expand this. Oh, go away. So what we're looking here, folks, is we're looking to see consistency. Your stop would be in the midpoint of the anchor bar. in case there's a pullback. So the anchor bar consists of this bar being above these 3 bars. No, I'm going to guesstimate as the anchor point or the stop level roughly here. Set this as a bright blue. And look, you have a nice, easy, consistent move here. Nice move back to the upside, 3.5%, back to 7%. As soon as you start here, your stop would originally be here. And as soon as you get above here, above this level consistently, this first level, 3.5%, you want to start moving your stop up to protect. And when obviously you get to this 7%, you want your stop to be right over here at this percentage for the remainder. That means you lock in the remaining 3.5% for the rest of the trade. So, okay, there you go. Subsequent trades, like these secondary anchor bars, you can do the exact same thing, but you want to allocate smaller amounts the further out you go. Well, the first one might be 70%, second one might be 50%, third one might be 40%, fourth one might be 30%, and down here you're just allocating a very small amount. So the idea here is your initial entry right in here, these reversals are what give you that opportunity. So here we go again, another initial anchor bar right here. This one looks like it doesn't play out as well. We come in here, drag this over to our 3% level, 3.5, and drag this over to our 7%. Notice how I'm marking it at the anchor bar level. Where are the 3.5 and the 7% levels at the anchor bar? And then, of course, my midpoint stop would be, if I can get it, would be the midpoint of the anchor bar of these previous 3 bars. So I would set my midpoint stop roughly right in here. That's about the midpoint of, I make it a little more visible, the midpoint of that anchor bar, okay, safely where we're at. Now you hit the first target here. Remember, first target, pull back 50, 60, maybe 65, 70%. Nice, easy, consistent. Now you want to move your stop up. So as soon as you hit this first target, you want to try to move your stop up, which would be here, moving it possibly up into your just below your entry level to try to eliminate risk. Obviously, at this point, the whole trade is profitable at this point, and you can see it reverse back down to the downside. So now let's do this one. Control. By the way, control allows you to grab multiple objects and move them. So here we go. We have a new anchor trade right here. We come in here, figure out where our 3 and 7% are. So our 7% is here. Our 3% is a little lower. Our midpoint of the anchor bar, remember, anchor bar consists of 1, 2, 3, 4 patterns. So midpoint level of the anchor bar is going to be roughly right here. So you can see that we come up, we carry onward here. We hit both targets, very consistent. This is the first one. So again, 70, 80% allocation. Second one, maybe 50, 60% allocation. Third one, maybe 40% or 30%. Fourth one, you're down in your 20, 30%. You could go here, maybe 10, 15. And remember, the further you go, the more likely you have risk. So you want to build what's called an inverted pyramid. Okay. And that's basically on this area. So I'm going to try to draw across here and then draw here. Let me do it this way. This would be an easier way for you guys to understand. Trend line. And trend line. So really, guys, at this initial level right here, you want to have essentially a bigger position. This is your not necessarily lower risk position, but as you continue to get multiple triggers in an uptrend, you do not want to stack in a larger and larger format. You want to start stacking trades in smaller and smaller allocations here. As you're moving upward, as you're seeing it continue to trend, you do not want to stack aggressively in the opposite side. So, for example, you do not want to start stacking like this, where you start with say 100%, then try to double down, then double down, then double down, then double down. I mean, in this case, yeah, it would have worked, but understand that that's not that's not logical as far as trying to achieve profitability. So, what I'm trying to teach you here is when the moving averages are consistent, when you get the anchor bar, you can use these 3 and 7% targets very cleanly for a targeting system. So, now we'll move back over here to COVID. So, COVID rolls down, it's still downward trending moving averages. So, we get a COVID move here. It's a nice solid anchor bar, kind of crazy, but let's look. We come in here, our 3% move on the anchor bar is right here. We would have gotten it. This is weekly data, remember? So come across here, and it's very easy to see that the next bar blew past all of our expectations, and our stop level would probably have to be the midpoint of the previous 3 bars, probably somewhere up here. And again, the midpoint, this is the anchor bar, 1, 2, 3. Midpoint's really right in this area. You can see we gapped down on the open, would have hit all of our targets. Moving averages by this point, we're moving down right here. And again, we get no new anchor bars. So we come back over here. You do get anchor bars here in a downward trend. I would ignore them. We do get anchor bar right here above the moving averages in a nice consolidated upward trending, but really you kind of want to wait for this or this. This is the new anchor bar here, sets up a very solid trend. Come in here, grab the positioning again. Come back over here, paste away. And look, very solid positioning. We come back in here. Sorry, got to move it. And look at how clean that works. I mean, here's our anchor bar, midpoint of the last 3 bars. Puts this right about here. Pretty much where I had it. Here's our 3%, 3.5% level. Here's our 7% level at the anchor bar. We easily hit these targets. So now, I mean, what is this? Okay. Is this a 3.5% target? No, it's a 1.35, 1% target. And then here is a 4.49% target. But I want you to understand this is on the Dow Jones DIA. That's a 3.2 profit for the bulkier profit. And then the secondary is a 12-point profit. Completely successful trade. You don't have to worry about it. This is an example here where we're probably going to get stopped. Well, we're going to hit our first target, which is going to make it profitable. Well, let me shrink this. And this is what I'm talking to you about. Is consistency is a matter of hitting targets and reducing your position size quickly. That's what consistency is. If you want to see a system that has an 80 or 90% success rate, you find something that goes in and scalps very quickly, very efficiently, in and out of the market, and is not trying to. Oops. Okay, let's do this. No, there's our 3% level, almost exact same. Here's our midpoint, 1, 2, 3. That's safe. Here's our 3% target, 3.5%, which is really only about 1.25%. But understand that when you hit that target, if you do then move the stop up efficiently, you can protect this trade so it has a very efficient move. Again, here's the same thing. I got to use control. Here's the same thing over here. Big gap up. Okay. We're going to have to take a look at this because we're already above the 3% target. So at this particular case, we would be looking at, the 3% target here, 7% targets here, big gap. I'm going to leave this right here. We would be entering the trade here. We would already be above our 3% target. So in this case, you might have to cut the position down to maybe 40 or 50%. We do hit the 7% target back over here. And again, we could move the stop up higher. You do have subsequent trades coming back in. You do get a secondary trade here. So again, come here. And remember, I've gone through maybe 10 trades so far. So far, about 85, 90% of them are winners. Here's our 3%. Here's our 7%. I'm sorry, I moved that the wrong way. Move this over one. There's our 3.5%. There's our 7% target. Our stop would have to be the midpoint between these last bars. You can see the midpoint of these last bars is actually way down here. We do come up, just barely tag the 3.5% target, and eventually get up to this 7% target way back over here, depending on how you move your stop into this entry bar area, the anchor bar. Likely just hit this 3.5% target, got stopped out. Then you get another one here, and of course, it just continues. I mean, it's just a simple little system with a fairly high degree of accuracy, and the triggering mechanism being the anchor bars gives us, where's the 3.5% at anchor bar? Roughly right there. Where's the 7% up here? Where should our stop be? There's the anchor bar. 1, 2, 3. Stop should be down in this area. We come up here, quickly hit our 3% target. We get a little roll around here. We eventually roll up and hit our 7% target right there. And again, another quick little winner. So again, when you're in these trades, and like I said, what you want to try to do is understand that mathematically, so understand, so you start with X, okay, whatever. X equals your entry allocation. So say that is 60%, whatever it is. 60% of, let's call it 5 grand. Let's call it 10 grand just to make it easy. So that means that you've got totaling $6,000. Okay, next, your 3% target here, 3.5% target, is going to pull 3.5% target, pulls 65 to 70% off right away, leaving only 30 to 35% of total allocation. So for you, in order to protect that, okay, your stop can essentially be to make it a profitable trade, can essentially be double whatever the 3% stop level is. And how do I figure that out? Well, if you're pulling 65 to 70% off right away at this level, leaving only 30, 35%, keep active, come back here. Sorry about that. Coming back here, you can set your stop at about double where your initial target level is. So the idea is you want to make sure that by the time you hit that 3% target, you know, like in this case, we were already above it. Okay. And you want to make sure that you can secure your stop above that level. See how this bar pulled back down? I would, after this move, this big gap up, I would move my stop to below this level here on the gap and see if we go ahead and move. On this level here, we get in. Here's our anchor bar. We move up. We hit this level on a high and then roll back down. At this point, like I said, you want to keep your stop level in a reasonable area. Okay, so we originally had our stop level down in this area. You want to keep it at a reasonable level, because even that pullback is still going to give you consistency. You can have that pullback almost come all the way back down, and it would not lose much. So hypothetically, if you had a 2 points, hypothetically, if you had a $2 3.5% target for 70%, you would make on your $6,000, just do the math real quick, about $3,700 roughly, and leaving your stop for the 30% at 4%. So leaving your stop at $4.5 hypothetically, for the rest would give you essentially, so you would have 4.5 times 2. So you would have 2,000. I've got to figure out the shares. So I got to figure out the shares. 326 grand. So this is wrong. You'd have about 370, let's say. And here you would have a risk, would risk about $400 roughly. If you didn't move your stop. If you do move your stop up into this area, your risk drops considerably. And again, so moving your stop higher after 3.5% target moves trade function into profits consistency. Okay. So understand that that's the general rule, and it works in any trend. Generally, you just want to ignore these. You don't want to be trading these downward bars in an upward trend. Okay, when you get over here into this downward trending, like this one, this is a what I call a pre-anchor bar. You could have taken a trade like this. You would ignore these. You could have taken anchor trades like this. You remember, you want to keep that diminishing factor. You do not want to keep stacking larger and larger amounts into the trade. If you're going to take these trades and you're going to stack, you want the biggest trade here, then a smaller trade, then a smaller trade, then a smaller trade, then a smaller trade. Same thing here. You could then add a major trade here, and you can see how this reacts. Trades backwards, doesn't really, I mean, we're already outside the 3% area, but this is a final trade here in a downward trend, and you can see we would ignore this, or you could trade it. I just would trade a 15 or 20 or 25% allocation. You're in a downtrend, it's a pullback, it's up to you. But the 3.5% and the 7% really work. I mean, here's another example. Look, downward trend here. Get the anchor bar. Here's our 3.5% level. Here's our 7% level. These become my targets. Very simple. We need to figure out the midpoint of the anchor bar for our stop. So we come here, we got the high here, very tight little 3 bars. So our stop level would probably be right in here. Set that as a dark blue. And looky here, folks. It came down, opened right here the following week at 336, came down to 330, $6 profit. We could have moved our stop down a bit to stay protected, came down, hit our 7% target, leaving a runner if we want. And again, you have the rolling trades here all the way down. Very consistent, folks, especially when you get over in this area. What you're really looking for, again, is to see that trend continue to migrate upward like you have right here. Let's see, we have over here. Now we're back in upward trending. Because these are late after so many anchor bars, only trade about 20% here. Here we have a reversal, new anchor bar that fails, comes back down, moves into bullish trending again, new anchor bars, and eventually new anchor bars and upward trending. I think you'll find that this is a moderately consistent system. And of course, the degree of slope that you see with regards to these envelopes here, you can see how this is sloping much more aggressively. This is sloping much more aggressively. These provide greater opportunity to see your stop move a bit more aggressive. When you're in these sideways trends, not quite as aggressive like right here. You don't want to be too aggressive with your position. It can get stronger, but this is telling you that this trend is moving at 4.5 miles an hour, where this trend is moving at 25 miles an hour, and that's a 600% increase in momentum to the upside. Same thing here, rolling very strongly on these anchor bars. You can't see it originally, but as you're moving up, you're getting very solid upward trending. And each one of these gives you the ability to move into new trades. Just remember, smaller allocation as it keeps going. And the same thing goes down to 30-minute. You come right down here to 30-minute, spread it apart. Now on a 30-minute chart, you can't use 3.5%. You can't use 7%. So you're going to have to reduce these. I would suggest moving down to 0.33 and potentially here 0.55. And that will give you remember, typical moves on the market are not more than 1.5% per day. So you want to remember that in these areas, maybe a 25 and maybe here a 45. Okay, that looks a little better. So here's the DIA as of Friday, getting a lot of little mixed triggers here on a 30-minute chart. You can see we're getting chopped up. Now, again, we wouldn't take a trigger that is directly opposed to the directional trend of the daily and or weekly. So weekly here, we're looking at the moving averages are up. So we would be looking at moving averages. You come down to daily. Moving averages are up. You come down here to 30 minutes, and all we would be trying to take are upward trending setups. So we would ignore these. We would take this in an upward trend, maybe this one. It gives us the same setup. The 2.5% setup is right here, or sorry, 25 tenths of a percent, and the 45 tenths of a percent is right here. And our stop level should be somewhere, because remember, this is really the confirmed anchor bar here. We don't have any bullish confirmation trend with the moving averages until right here. And at that point, we can take the trade at the end of this bar and try to catch it. And because we have the midpoint, our stop level would probably have to be down here. And you can see just as easy, click, click right there. And then boom, another one here in an uptrend. Come back over here. Find my 3.5 and 7% right there. Move my stop. Where's the midpoint of the previous 3 bars? Is right around that area. Target here, target here. We've already hit the first target. We're moving up. We had a subsequent anchor bar trigger. Nice and easy. Again, nice and easy. So I'm going to end by showing you this again and scrunch this out, figure out where my text descriptions are. Here we go. So the general rule is simple strategy for traders is right here. Let me shrink this, drag this up. And I will shrink this and try to drag this down here. So there's your general rules right there. Okay, you want to remember to maintain consistency, you want to have easily accessible targets, quick little scalps in the market. And this is and you never want to build your allocation level in an inverted pyramid. This is, if you build in this manner, larger and larger positions, you're stacking greater and greater risk all the way out here. It could wipe you out really bad. I mean, just horribly. No matter what you learn, this little move right here will allow you to stack a little bit more into subsequent positions. Just make sure they're smaller, all the way down to very small percent. Remember, each time you take these targets, you're locking in decent little profit. So it gives you a little extra room to throw a couple more nickels at it, so to say. But there you go. Nice and consistent. Okay, guys, talk to you later.